At 11:47 a.m. Eastern Time, something happened in Ottawa that did not look dramatic on television. There were no raised voices, no emergency graphics, no visible panic. Canadian Prime Minister Mark Carney walked to a podium, adjusted the microphone, and began speaking in a calm, deliberate tone. But within minutes, traders in New York, analysts in London, and corporate executives across North America started paying attention. Because what Carney was doing was not simply giving a press statement. He was redrawing the perception of leverage between Canada and the United States. And in modern geopolitics, perception is never just optics. Perception changes risk. Risk changes capital flows. Capital flows change real-world outcomes. For weeks, the dominant narrative coming from Washington had been clear. President Donald Trump repeatedly argued that tariffs gave the United States overwhelming economic power over Canada. The message was simple and politically effective. America is bigger, America is stronger, and America can pressure Canada until Canada gives in. The underlying assumption was that Canada had limited alternatives and would eventually be forced back to the table on Washington's terms. At first glance, that assumption sounded logical. The United States remains the largest consumer economy in the world. Its financial markets influence global investment decisions. Its currency anchors international trade and commodity pricing. It has scale, liquidity, and unmatched political visibility. For decades, those advantages translated into negotiating strength. But size is not the same thing as leverage. Leverage depends on dependency. And in a deeply integrated North American economy, dependency is rarely one-directional. Carney understood that the real battlefield was not the press room itself. It was the expectation layer above it, the way investors, governments, and corporations interpret what happens next. Markets do not wait for perfect certainty. They move on probabilities. Corporations do not invest based on speeches alone. They invest based on what those speeches suggest about future stability. Governments do not negotiate in a vacuum. They negotiate inside a web of constraints, alternatives, and time horizons. So Carney did not try to win the loudest headline. He tried to shift the probability map. He began by addressing the assumption that Canada lacked options. In measured language, he emphasized that Canada is not an isolated economy tied to a single market. It is a resource-rich, industrially capable, financially developed country integrated into multiple global networks. Canada exports energy, it exports minerals, it exports agricultural products, it supports manufacturing supply chains, it attracts capital when conditions appear stable, and most importantly, it can expand relationships when risk rises in one channel. That point matters more than it may seem. In modern trade systems, power is not only a function of domestic strength, it is also a function of optionality, the number of credible paths available when conditions change. A country with one buyer is vulnerable. A country with multiple buyers is difficult to corner. A country with one financing channel is exposed. A country with multiple financing channels can absorb shocks. Carney's message, stripped of politics, was this: Canada has optionality, and optionality is leverage. He then moved to corporate behavior, which is often where political narratives meet economic reality. Corporations do not allocate billions of dollars because one leader sounds confident on television. They allocate capital based on expected returns and expected risk. They model tax regimes, labor costs, logistics reliability, policy stability, regulatory predictability, and political volatility. If one jurisdiction becomes harder to model, capital does what capital always does. It starts looking for alternatives. Carney noted that Canada had seen increased interest from multinational firms evaluating expansion, relocation, and risk diversification. He did not frame this as a victory lap. He framed it as a rational response to uncertainty. When policy signals become volatile, companies seek stable operating environments. When timelines become unclear, they prioritize jurisdictions that can provide predictability. When cross-border friction rises, they revisit exposure assumptions that had been treated as fixed for years. This is not ideology. It is decision theory. Investment seeks visibility. Visibility reduces uncertainty. Reduced uncertainty lowers risk premiums. Lower risk premiums support long-term commitments. That sequence is not political messaging. It is how boardrooms work. Energy was the most strategically sensitive element of the entire discussion, and Carney knew it. Canada plays a critical role in North American energy systems, particularly in crude oil flows that support American refineries designed around specific grades of supply. These relationships were not built overnight. They were built over decades because they were efficient, geographically rational, and commercially stable. Pipelines, storage terminals, transport routes, and refinery configurations evolved around assumptions of cross-border reliability. And those assumptions matter because energy infrastructure is not easily replaced. You can change a speech in one day. You cannot redesign refinery inputs in 1 week. You cannot reroute long-established energy systems overnight without cost. Infrastructure has memory. It locks in decisions made years earlier and carries them forward into future crises. That is what creates structural interdependence. Carney did not threaten disruption. He did not need to. He simply described the architecture of the system. By doing that, he reminded everyone listening, markets, policymakers, and industry, that leverage in an integrated energy system is reciprocal, not unilateral. Reciprocal dependence changes negotiating behavior. It raises the cost of escalation. It shortens the distance between political rhetoric and economic consequence. Financial markets began adjusting quietly, which is often how serious repricing starts. Currency desks reassessed exposure to policy uncertainty. Portfolio managers recalibrated assumptions about cross-border political risk. Energy traders watched for signs that even without immediate physical disruption, the premium on stability might rise. Equity analysts updated scenarios for companies with supply chain sensitivity to North American trade friction. None of this looked like panic. That is exactly the point. Real market shifts often begin with subtle changes in probability weighting, not dramatic headlines. A small change in expected policy stability can alter valuation models. A modest increase in uncertainty can affect timing decisions for investment. A slight rise in cross-border risk perception can push firms to diversify sooner than planned. Carney's appearance was effective because it targeted that exact layer, the layer where perception becomes pricing. The broader significance of the moment extended far beyond one speech or one dispute. Canada was signaling that it would not present itself as a passive object of American policy pressure. It would present itself as a sovereign economic actor capable of adaptation, diversification, and strategic patience. That framing matters because confidence is contagious. When a government demonstrates clarity under pressure, it can stabilize expectations not only at home, but across partner networks. International observers recognize this immediately. Governments and corporations watch for signs of policy coherence because coherence influences long-term planning. A country can be smaller and still attract investment if it is easier to model. A country can be powerful and still lose efficiency if policy signaling becomes inconsistent. In a world of constrained capital, constrained capacity, and fragile supply chains, predictability itself becomes a competitive advantage. That is why moments like this matter. They are not only about who wins the day's headline. They are about who looks governable, who looks investable, and who looks capable of sustaining relationships under pressure. For the United States, this moment served as a reminder of a reality that often gets lost in political messaging. American strength remains enormous, but modern economic power exists inside networks, not above them. Supply chains cross borders. Capital responds globally. Energy systems rely on geography and infrastructure. Manufacturing competitiveness depends on timing, reliability, and cost certainty. Political power still matters, but in integrated systems, forceful rhetoric does not automatically translate into costless leverage. Sometimes it creates counter-incentives. Policies designed to increase pressure can accelerate diversification. Diversification reduces dependency. Reduced dependency changes future leverage. This does not mean the United States suddenly becomes weak. It means the balance of influence becomes more conditional and more contested. It means outcomes depend less on one-time declarations and more on the durability of institutions, relationships, and alternatives. Carney's communication style reflected his background in financial crisis management and central banking. People trained in those environments understand something political strategists often underestimate. Confidence is infrastructure. It is invisible until it breaks, and when it breaks, everything becomes more expensive. Borrowing costs rise, investment slows, decision-making narrows, optionality shrinks. So instead of escalating emotionally, Carney did the opposite. He used controlled language, he kept his tone steady, he emphasized systems, incentives, and consequences. He avoided personal confrontation and focused on structural facts. The effect was not theatrical, it was stabilizing. And stabilizing is exactly what markets reward during uncertainty. This is one reason his message carried beyond Canada. He was not just speaking to voters, he was speaking to investors, boards, ministries, and allied governments. He was signaling that Canada understood the mechanics of the moment and intended to act strategically rather than react emotionally. That signal strengthens credibility, and credibility has real economic value. Credibility affects financing conditions, it affects investment timelines, it affects the willingness of partners to sign long-term agreements. It affects how quickly corporations move from monitoring to committing. In times of stress, credibility can function like an asset class, intangible but deeply consequential. The long-term consequences of moments like this rarely appear all at once. They unfold slowly, then suddenly. A company revises an expansion plan. A ministry accelerates a trade outreach initiative. A logistics team adds redundancy to procurement channels. An investor rebalances regional exposure. A manufacturer rethinks concentration risk. Each change appears manageable in isolation. Together, they reshape the economic map. This is how strategic shifts happen in the real world. Not always through dramatic rupture, but through accumulated adjustments made by actors responding to changing incentives. For ordinary citizens, these shifts can feel distant at first. Most people do not watch currency desks repricing risk or portfolio managers adjusting assumptions. But over time, the effects become tangible. They show up in hiring decisions, in factory placement, in transportation investment, in regional growth patterns, in which industries expand and which pause, in whether prices remain stable or become more volatile. That is why speeches like this matter even when they appear calm on the surface. They can alter expectations that shape thousands of downstream decisions. The essential lesson from this moment is not about spectacle. It is about positioning. Leverage is not created by volume alone. It is created by alternatives. The side with credible alternatives negotiates from stability. The side without alternatives negotiates from necessity. Stability permits patience. Necessity compresses time. And in negotiations, compressed time usually benefits the side with more options. By demonstrating that Canada had options, Carney changed the tempo of the dispute. He did not need a dramatic confrontation. He needed to make clear that Canada could absorb pressure, adapt, and continue building pathways outside a single dependency structure. Once that perception takes hold, the bargaining environment changes. Threats become less decisive. Timelines become less predictable. Markets begin assigning higher probabilities to outcomes that political rhetoric had previously dismissed. That is exactly what Washington did not want. Because once investors and corporations start modeling a world in which Canada is not cornered, the leverage story becomes more complicated. Complexity is manageable in policy. It is dangerous in messaging. Political narratives rely on certainty. Markets punish it when the certainty looks artificial. As the press conference moved toward its close, there was no dramatic climax. Carney did not declare victory. He did not announce retaliation. He did not attempt to dominate the news cycle with a memorable insult. He simply reinforced the same core message through tone and structure. Canada would respond to pressure with strategy, not panic. That discipline may prove to be the most important part of the entire event. In political confrontation, emotional escalation often creates short-term visibility, but long-term fragility. Strategic discipline does the opposite. It can look understated in the moment, but it builds confidence over time. And confidence, once reinforced across markets and institutions, can become a source of national leverage in its own right. When the cameras shut off, the speech ended, but the repricing of expectations did not. Boardrooms continued discussing exposure. Analysts continued revising scenarios. Government officials continued reassessing diplomatic and economic pathways. Traders continued watching signals for whether rhetoric would intensify or stabilize. None of that required a headline to continue. It was already embedded in the system. Because in modern geopolitics, power is not always displayed through noise. Sometimes it appears through preparation, coherence, and credible alternatives. Sometimes the most consequential move is not the loudest one, but the one that changes how everyone else calculates risk. And on that morning in Ottawa, Mark Carney made exactly that kind of move. He did not overpower Washington in a theatrical showdown. He did something more durable. He shifted the frame through which markets, corporations, and governments understood the dispute. He replaced a narrative of inevitability with a framework of interdependence. He replaced a story of weakness with a demonstration of optionality. And by doing so, he reminded everyone watching that in an integrated economic system, leverage belongs not just to the largest player, but to the one that can remain stable while others are forced to react. That is why this moment matters. Not because it ended the dispute, it did not. Not because it triggered an immediate collapse, it did not. It matters because it changed the assumptions that shape what happens next. And in a system where assumptions drive capital, policy, and strategy, changing assumptions is often the first real move that counts.